It is as essential for the manager to understand financial management as it is for the manager to understand production techniques, marketing, and all the other factors of the business. To develop and manage the financial aspects of the nursery business properly, nursery managers should have the services of a lawyer and an accountant and understand the appropriate use of the information provided by these professionals. They only advise. The manager makes decisions and therefore must understand financial information and how it can be used to the full advantage. I'm Dr. DeBusk, and this video discusses securing finances to start or continue a nursery business. The importance of financial management cannot be overemphasized. Money is used to purchase labor, materials, and in some cases, the management and technical expertise necessary to start and operate a nursery. Financial statements and records are used to evaluate the current financial health and past accomplishments of the nursery firm, determine the appropriate income tax liability, and assist in securing the additional financial support needed for a growing business. They may also be used to help predict growth and/or identify those divisions with greatest potential for profit. Financial records are one of the major sources of information needed in the management of a nursery, but not the only source. Financial records are not to be used as a substitute for good judgment and experience in nursery production, marketing, and personal management. Money is needed to finance the purchase of equipment, land, structures, supplies, and labor necessary to begin to produce nursery crops. A nursery manager usually has three potential sources of funds. 1. The owner's personal savings. The owner's investment of personal savings, cash value of insurance policies, and funds generated by mortgaging personal property demonstrate his or her commitment to the business and ability to earn and save, both which are important in developing the proper personal and business credit ratings needed to obtain future financing. 2. Funds generated in the nursery through profit and depreciation accounts. The sale of products and services in the business produces money needed for general payment of taxes, cost of bad debts, interest and loan repayment, profit and depreciation. 3. Borrowed funds. Borrowed funds are used both to initiate and in most cases to operate a nursery. There are a variety of sources of borrowed financing available to the nursery manager, including partnerships, contract growing, and loans from a variety of financial institutions. Partnerships can be developed for the purpose of obtaining additional funds for capital investments. This involves sharing management decisions and profits with all full partners. A successful business partnership usually requires that the partners have separate and well-defined management responsibilities. Limited partners may invest in specific crops which the nursery plants maintain, harvest, and markets for the partnership. The terms of the partnership agreement should specify the yearly investments required of the limited partner, the services provided by the nursery, the terms of marketing, and the distribution of profits. Limited partnerships are easiest to develop for an established firm because the investor considering a limited partnership is usually relying on the principal partner's demonstrated nursery management ability as well as detailed production cost analysis as partial security for the investment. Certain income tax advantages can be provided to the limited partner, which may make this type of investment appealing to the investor. Limited partnerships may also be developed to allow key employees or individuals with valuable technical expertise to become involved in the financing and management of a division of the firm. In this case, the primary purpose of the partnership may be to obtain expertise or to retain and motivate a valuable employee rather than to obtain financing, even though the employee invests funds in the firm and shares in the profits derived from the limited partnership. Another source of funds, called contract growing, involves using capital obtained from other firms that are involved in marketing nursery stock. A manager may contract to produce a specific crop at a specified price for another firm in return for receiving the financing necessary to produce the crop. In some cases, the marketing firm may provide the plants, supplies, and equipment needed to produce the crop. The firm loaning the money receives the benefit of having the entire crop at a specified price, a hedge against inflation, to complete the range of nursery products and markets, whereas the nursery receives the benefit of the financing and a guaranteed market for the crop. It's really a win-win for both sides. An example is a company called WCI, a large builder in Florida. The nursery had a $2 million contract over a 2-year period to produce hundreds of 300 to 400 gallon ornamental trees. They had the guarantee of getting their trees at a certain time, and the nursery had the benefit of a guaranteed sale, so a benefit on both sides. A nursery manager may also borrow money from a number of traditional financial institutions. Borrowing from a financial institution involves obtaining capital to be repaid with interest on a specified schedule in an agreement or note signed by the nursery manager and the creditor. One of the advantages of borrowed funds is that the nursery manager does not share management control with creditors, as is usually the case with contract growing or partnerships. In most cases, buildings, land, nursery stock, equipment, and other assets that are owned either by the nursery or by the owner of the nursery are placed as security or collateral for the loan. A number of insurance firms specialize in providing mortgage insurance for agriculture, including the nursery industry. As far as loans are concerned, there are a few categories, and they are based on the length of the loan. A short-term loan, up to a year, are usually used to finance working capital for short periods of high expense and low income. Bankers will generally lend up to 80% of accounts receivable. Accounts receivable is defined as money owed to a company by its debtors. Intermediate loans are 1 to 5 years and are used for financing equipment. Banks may supply up to 90% of the value of the equipment being purchased. Long-term loans, which are 5 years or more, are used to finance land, buildings, and other capital improvement or expansion. Bankers may supply up to 60 to 70% or more of the assessed value, not market value, of property and real estate. As far as the security provided, we have real estate, the land itself, the crop, the plant material, stocks and bonds from private investors, and equipment. Your type of lender may be broken up into banks, government agencies, finance companies, private individuals, and private businesses. This happens a lot in the business world where companies buy up each other, and we've seen companies merge, especially when it comes to the nursery industry. The purpose of the loans may be to purchase real estate such as additional land, greenhouses, storage facilities, lath or shade houses, install drainage in a field, etc. Loans may also be used to purchase liner stock, fertilizer spray materials, equipment, etc. It can also be used to pay labor and management. The nursery manager must determine the best expenditure for the limited capital available before approaching financial institutions and any other source of funds. Capital investments must be thoroughly evaluated by the manager to ensure the sound financial management of the nursery. The initial step is a thorough search within the nursery operation and the markets it serves for all possible profitable investments for the available capital. These alternative investments must be described in detail. The total capital required and the added earnings expected, cash flow, should be forecast for each alternative investment. Profit may not be the only factor considered. The impact of income taxes and other taxes, as well as the potential for future growth and ability to provide a stable future income, may also play a major role in the selection of an investment. There are a number of methods for measuring or comparing the potential economic benefit for alternative nursery investments. These methods of analysis vary considerably in their complexity and reliability. No decision can be more reliable than the data used in making that decision. Some nursery managers, particularly in the early stages of the growth of the firm, tend to evaluate a potential investment in a crop or type of equipment only when presented with a crisis deadline. For example, a nursery manager may discover that as a result of overproduction, rooted juniper cuttings must either be sold substantially below cost, planted in their nursery's own production fields, or destroyed. The decision to plant the rooted cuttings is frequently made even though the manager is aware that they may well be beyond his or her current and projected ability to profitably market them. Some decisions must be faced without taking the time to consider alternatives. For example, if a tree digging machine breaks down during the digging season and requires extensive repair, a replacement must be purchased immediately to allow harvesting to proceed. Making an investment based on urgency may be necessary, but may be inappropriate for long-term investments and is not an appropriate substitute for good financial management. A second method of capital investment analysis involves the determination of the payback period for alternative investments. The payback period is the time it takes for earnings from an investment to pay back the entire initial investment. For example, a nurseryman might have the opportunity to produce and market 4.5-inch caliper shade trees. The manager could either buy 2 or 2.5-inch caliber trees or buy 6 to 8 foot whips to begin to produce the trees. Purchasing 6 to 8 foot whips might require a 10-year production period with additional investments each year in cultural care and land cost. The 2.5-inch caliber trees might require only a 5 to 6 year production period with yearly investments for cultural care for only the 5 or 6 year period. Since no earnings are received until the trees are sold, the planting of 2.5-inch caliber trees has the shortest payback period, 5 or 6 years versus 10 years. Tree whips might be purchased for $5 each, while 2.5-inch caliper size might cost $27.50 each. Not only are the 6 to 8 foot tree whips substantially cheaper to purchase, they would cost less to ship and plant, and might have a higher survival rate after planting. The 6 to 8 foot whips could produce a greater profit even though they require a longer investment period. The payback period method measures how quickly an investment can be converted to cash and is therefore a measure of the firm's liquidity, the relative ability to convert assets into cash, or financial flexibility rather than profit. There are also management advantages in having the increased flexibility provided by shorter-term investments as compared to long-term investments, but this advantage should not be confused with the profitability of a potential investment. A third method for analyzing alternative investment opportunities is to compare the simple rate of return on an average yearly basis. Consider the following investments. An investment in tree digging machine A of $25,000 will produce additional earning, savings, and labor of $7,500 per year. The depreciation is $5,000 per year over an expected machine life of 5 years. The simple rate of return of machine A is additional earnings minus annual investment divided by the total investment equals the percentage annual rate of return. 10% is the average annual rate of return for this particular investment. An alternative investment could be made in a more efficient machine, B, which could only be leased. This machine would cost $6,400 per year and provide a savings of $8,000 in labor per year. The simple rate of return would be $8,000 minus $6,400 divided by $6,400 times 100, which equals 25%. Machine B would produce only $500 more per year in earnings than Machine A, and its simple rate of return on money invested would be 25% as compared to 10% for Machine A. The simple rate of return indicates which investment would provide the largest added earnings on a yearly basis. However, it is not really comparable to interest rates on borrowed funds because the total investment is not made for the life of the machine. The entire $25,000 is not utilized during the entire 5-year period. Investment analysis may also be used to answer the question, what is the most efficient rate of production? A break-even analysis is based on the fact that in each nursery operation there are fixed costs which do not change, within certain limits, as the volume of production either increases or decreases. These costs might include the cost of capital invested in equipment, buildings, and land. Variable costs, on the other hand, are directly tied to the volume of production and sales, increasing and decreasing in direct proportion to increases or decreases in volume. A break-even analysis requires the graphic display of fixed costs, cost of goods sold, variable costs, and net sales at 2 different volumes or rates of operation. Successful financial management usually requires the borrowing of funds from a variety of potential lending institutions. Most lenders will require financial data from the nursery audited by a certified public accountant, as well as information regarding ownership and management and the objectives of the proposed financing. The lending institution may be interested in the type of accounting system used, a current balance sheet, a profit and loss statement, the relevant financial ratio analysis comparisons, and the long and short range financial outlook of the entire nursery industry. They may also wish to see an audit of the accounts and past financial records of the firm. The lenders will be interested in objectives of the loan, the payback schedule, the projected budget, how the money will be used, and the resulting schedule of investment. The lenders will also be interested in the proposed collateral. There are at least 3 ways to assign value to a nursery crop in the field. One system begins with the wholesale price of nursery stock of similar size and grade, then subtracting a harvest and selling cost to arrive at an in-the-field value. A manager might estimate that harvesting and marketing a particular nursery crop contributes 25% to the total cost of the crop. The in-the-field value of the crop would be 75% of the wholesale price. This method will include profit in the value assigned to the crop. A second method, based on costs of production, totals all production expenses, including labor, equipment, supplies, cost of land, taxes, and plants involved in developing the nursery crop to its present stage. This method will overestimate the value of the nursery crop when it is very young because the planting and cultural care may be substantial for the first 1 or 2 years, during which relatively little growth occurs. A third method for assigning value to a nursery crop uses an outside consultant to provide a professional appraisal of what the specific nursery crop would sell for in a forced auction sale. Nursery crops or any other item of collateral should be precisely defined, because the nursery would be turning over control of that crop to the lending institution if and when the terms of the loan were not met. The successful negotiation of a loan also requires that growers know as much as possible about the lending institution. In many cases, the refusal of a loan has little to do with the quality of the firm and management requesting the loan, but is the result of regulations and limits set by the lending institution. A business manager requesting substantial financing should know the lending institution's loan limits, the maximum loan that can be made to one customer, and the maximum length of time it will be loaned. The board of directors of the lending institution determines the broad guidelines and nature of the loans it will make. Those lending institutions having strong ties with agricultural industries will quite likely be more confident in making nursery business loans. The nursery manager will want to know how frequently the loan committee meets in order to estimate the time necessary to obtain financing. As in any business, it is good to compare the financial services of competing lending institutions. In summary, there are many different ways to obtain financing to start a nursery. It is your job to research all the different opportunities there is to obtain capital and funding for your nursery.